where every week we try to bring you some information that makes your life easier when applying for a loan or other things that you may be doing with your house as far as refinancing or building a property or remodeling. And I'm going to be going solo today. I am sporting my Longhorn shirt today because I'm going to the game tonight for the free ticket from my good friend Rick Morier. So shout out to Rick. But I wanted today to talk about something that occurred to me on a flight back from Puerto Rico about 3 weeks ago, about a month ago now. And we were flying over the Gulf, and the pilot came on. I think it was a Southwest Air, no, it was American Airlines, and he says, "Hey guys, we're going to be going through some turbulence here shortly in the next few minutes. So go ahead and get your seatbelt buckled down, like they do." And lo and behold, we did. We went through some turbulence. It wasn't too bad, but it was a little rocky for a few minutes. And so I was thinking about the idea of getting a mortgage and relative to landing a plane. My job as a mortgage broker is to work with you all the way from the beginning, like takeoff, all the way through to we land, which is what we call the closing date. And along the way, sometimes there's turbulence. Now, over 40 years, I've seen a lot of situations come and go. I've closed thousands and thousands of mortgage loans, and everyone's a little bit unique. Now, sometimes there's not a lot of turbulence, but sometimes there are. So I sat down and I wrote out 88 different types of points of turbulence in a mortgage. Now, there could be 8,000 for all I know, but I want to share a few of those today. We won't be getting through all 88, but I kind of want to hit things that you may be thinking about or prepared for when you're going to be applying for a mortgage to buy a house or remodel a home or whatever you're going to be doing. So let's start with one that happens very, very rarely because people don't think about it. Now, I usually inform people not to do this up front. I say, here's the things we don't want to be doing. The first thing you don't want to do is change jobs before closing. Now, I've had situations where they do that and everything has worked out. It delays things a little bit because when we have to back up and verify new income and wait for a pay stub and things like that. So it's not always a traumatic. It just delays things. So typically, if you can wait to delay a job, matter of fact, I'm working with a man now who's with Apple. He's with Apple. And he's thinking about taking another job with Amazon. Okay. And he's got an offer. I said, well, don't start yet. Let's get this thing closed. We only need 3 more weeks. We'll get this thing wrapped up. He says, okay, I'll wait. Now, he would still qualify for the loan, and that wouldn't be a problem. But what is a problem, let's say I've had engineers, as an example, working for a company as a W-2, and they go off on their own, maybe not during the process, but prior to applying for a loan, they'll go off on their own as a consultant. Maybe they're an IT expert and they want to start their own business. Now that is a problem. When you shift businesses from one to another with a like kind salary or a raise, W-2, that's not a problem. But don't change jobs prior to closing a loan in the loan process. Another thing that happens is people don't think about this either. I mean, I tell people these things, but sometimes they forget or whatever. But sometimes in the process, their credit scores will drop. Now, lenders will generally run your credit up front, get you pre-approved based on your credit score at that time and your credit profile. Now, if you go out and buy a car or something during the process, that's going to do 2 things: drop your scores, and it's also going to increase your debt to income ratio. So don't go out and buy major items like household goods, a car, another home, anything that's going to cause your credit scores to drop. And certainly don't miss any payments, because the lender has the right to run your credit again before closing. If they see more debt on there or an inquiry for debt, they're going to want explanations. They want to know if you've applied for more credit. And so that's another situation that comes up. I recently had a guy who refinanced his car during the process. And when we reran his credit, it showed 2 car loans. We only had 1 car loan because the other was paid off, but the credit bureau hadn't reported that yet. So it looked bad for just a minute. We got it handled pretty quickly because we could show that he paid that car loan off. But that would be an example of having to rerun credit and then something pop up. And that speaks to another thing we just kind of talked about: opening new debt. Don't open any new debt. Don't inquire for a new credit card. Don't inquire at Kohl's or any place to buy appliances. Don't be going to buy refrigerators and freezers before closing. That's just, you have to wait. You can go the next day after closing. Okay. Sometimes property condition issues pop up, and this is usually found during the appraisal or the inspection. Now, the purpose of an inspection, and we don't require an inspection as a lender. We don't care if you've got the property inspected or not, because we're going to come back during the process and get an appraisal done, which is our inspection. The purpose of an appraisal is twofold. It's number one, to determine value based on the comparable sales in the area, and to make sure that the collateral for the lender makes sense, that we're going to loan money on this property. Okay, now the property appraises low. That could be another issue that comes up, but let's assume it all comes together. But prior to that, you're going to have an inspection done, and they usually run $400 to $500, and they're going to look at all sorts of things that the lender may not look at. They may have a termite inspection done. Most loans don't require a termite inspection. VA is the only one that really does. So if you're getting conventional financing or FHA, the lender doesn't care if you have a termite inspection. They don't care if you have an inspection at all, for that matter. But most people do. Smart money means get an inspection done with a qualified home inspector who's going to look for things like roofs and termites and electrical and plumbing and anything that kind of comes up that's not so much to code, but maybe it causes an issue down the road. We see a lot of that in Central Texas around roofs, as an example, because Central Texas is prone to having storms and hailstorms, and people may not know they have hail problems. They may not know they have damage to their roof. But what an inspector may know, and I'm doing a loan now for a man in Jarrell. He's moving to Jarrell and buying a home using USDA financing. We're not talking about loan products today, but USDA is a zero down loan product where he's not having to put any money down. He had come to me approved with USAA, which is an insurance company. They also do mortgages. It's a big national group out of San Antonio. And they were going to require him to put down $20,000. And so the realtor referred me. I'll just give you a quick story on this. The realtor referred me and, for a second opinion. And I said, well, John, you're going to qualify for a zero down loan through USDA because of where you're buying and your income level. There's two things. They're going to look at the where the property is. It's usually rural housing like Jarrell. And they're going to look at that you don't make too much money, to qualify for this zero down program. So I was able to offer him a better rate, zero down, lower mortgage insurance, and everything went fine. But in the meantime, the inspection showed that the roof really needs to be replaced. And so the seller didn't really know that. It's an investment property. The seller's in California. They weren't aware of any storms, but the inspector found that out. And he qualified through negotiation that he's going to get a brand new roof. They're putting that roof on Monday. And we're going to wait to get the appraisal done with the brand new roof. And then it'll make value for sure. But it's actually appraised by the county for $50,000 more than he's paying. It's appraised for like 303. He's paying 250. So I said, well, John, we're going to have to use the taxes based on last year for the escrow at the higher rate. But next year, you'll appeal that to the county, and they should bring it down to the 250 you paid for. Your taxes will be coming down. You'll file a homestead. So he's going to have an overage next year in his escrow account, which is a great thing. He was very happy. And that's the key, to make everybody happy. So let's see what else pops up occasionally. Condo approvals. Now, I've got, like I said, 88 things here to talk about, but I'm just kind of highlighting a few that we see a lot. Condo approval problems. Now, when people come to me for a condo loan, we have all sorts of outlets for condos. It's not an issue unless you're trying to do an FHA or a VA loan, because FHA and VA require that the complex itself be approved by FHA or VA. And there's standards they're looking for. And there's not that many complexes that are actually approved by the governmental agencies. So most condos are either going to be paid for cash by the borrower, or they'll get some level of conventional financing. Now, the secondary market, is we've talked about some of over the past couple years here, is controlled by Fannie Mae and Freddie Mac. They're the big secondary lenders who buy these mortgages, and they have certain guidelines and standards. So if you're putting down 5% and you're trying to buy a condo, the lender not only approves you as a borrower, for income, credit, the standards, but they also are going to approve the complex. And this can get tricky, because if you're putting down just 5%, there's a questionnaire the HOA has to fill out. And it's very detailed around reserves of in the bank account, how many people own more than 10 units. It's all sorts of questions. There's probably a good 20 to 25 questions that the HOA has to answer. If it doesn't meet Fannie Mae guidelines, then we can't do it using Fannie Mae. We're going to have to go what they call a non-QM source, which is usually banks that will do the loan, but they're going to do it a loan at a higher rate. So you're better off, if you can, putting down 10% on a conventional financing, because the guidelines to get approved are much, much easier. And usually if you put down 10%, there's what they call a limited approval, which is not a big deal, because Fannie Mae will take that. So you're going to get preferred rates if you can put down the 10%. Another one that pops up occasionally is IRS plans or tax liens. As an example, I had a guy apply a few months ago, and he wasn't self-employed. He had a W-2 job, but he had rental income. He had 2 properties that he rented out. So what we require for him is copies of the last 2 years' tax returns to show the income or the loss on those rental properties. That can also count against him or for him, or they, if in fact he's applying for a loan. Typically, if you just have a W-2 job and you don't have any other properties, they're not going to ask for your tax returns. They're just going to ask for your pay stubs and W-2s and where you've worked the last couple of years. But in his case, he had these rental properties, and it was 2024 return that we got because he hadn't filed 2025 yet, which he's probably filed now. But anyway, he showed that he owed the IRS about $8,000, because that's what it showed at the bottom. I said, well, can we need to prove that you've paid the IRS at $8,000. He said, well, I haven't exactly paid him on a payroll plan with them, which was only about $300 a month. But that would be a debt that didn't show up under the credit report. So I wouldn't have known about it. He didn't tell me about it because he didn't really probably think about it. And he's not trying to get anything by me. He just didn't think about having to disclose that. But we did, and he still qualified, but that would be a situation in a process that I wouldn't have known until I got to the paperwork that we needed to show to get the loan approved. Otherwise, if you do have a lien by the IRS, then we're going to have to get that thing handled. That has to be paid at closing. In other words, I had a buyer who came to me to get approved for a new house, but he was selling a home, but he had a $90,000 tax lien on his property that he was living in. And he'd been there for about 15 years. He got some IRS problems back about 5 or 6 years ago, couldn't pay him. The IRS filed a lien on that property, and that has to be cleared up, which he paid at closing. So it relieved him not only that responsibility, because he was also paying that back monthly at about $500 a month. So he was able to take some reserves, what was left over after he paid closing costs, and he paid the realtor fees, and he paid the IRS off, and yada yada. He had about 50 grand left. He was able to buy a new property, lower his payment, get rid of the IRS. So that worked out real well as well. Earnest money problems, that comes up occasionally. It's not a big deal, but I had a situation a few weeks ago, and a client of mine, well, he's a contractor. He's an AC guy, very good air conditioning guy that I've hired before. He came to us to buy a house, and so he was buying a mobile home, a double wide down in Belleville, and so anyway, long story short, we have to verify the earnest money, because the earnest money is going to be a credit. Usually when you contract, you're going to write 2 checks. You're going to write an earnest money check to the title company, whatever title company it is, for, let's say, $5,000. In his case, it was around $3,500. And you're going to write an option fee check to the seller that says, I'm going to look at this property for a couple of weeks. And if I back out, you can keep my option money. Okay. It's usually at $100, $200, something like that. And so anyway, long story short, he also had a side business that he didn't tell me about, because he was an employee of a company to do air conditioning work, made good money, but he also did a little side work on the side by himself and a partner. And so the earnest money, we verified it came from the company that he owned, not from him personally. I said, well, this isn't going to work. I mean, we can't, because then we're going to have to get tax returns and all sorts of stuff on the other company. He said, well, it's just a little side business. I said, well, we don't want to show that. So we're not going to show that earnest money. We're going to have to come out. It has to come out of your own pocket. It can't come from your company. So we had to revise the deal, and where he could then write another check. We refunded the earnest money back to him and his company, and then we were able to write a check for the earnest money out of his personal account. That's the only way we could count it in the formula when you go to cash to close. They're going to want to know where the money came from. One thing about lenders, and it's always been this case in 40 years, but in the last several years, it's even more so where they're really looking at paper trail because there's so much fraud out there that they're going to paper trail everything, and we're going to get to some of that again as we talk further. As a matter of fact, let's just talk about it right now. because the what one of these turbulence deals is what they call large deposits. Getting back to the idea of paper trailing money, lenders are very good at wanting to know exactly where the money's coming from. And any large deposit, they're going to want to verify. They're going to want to some explanation, or they're going to document it, or where did this $10,000 come from? Like I had a client, it was last year, and recently he had a $10,000 deposit into his account. It's the same account he was using for his down payment. Okay. He had plenty of money in the account. That wasn't the problem. But this $10,000 check showed up, and then I'm like, I said, Bill, we need to know, we have to verify and document where this 10 grand comes from. And it really offends people because it's like, it's none of your business. Well, it's none of my business, that's for sure. But it is the lender's business because that's the way the rules are written. So he said, well, a buddy of mine I'd lent some money to, he paid me back. And so that that wasn't the greatest explanation, but that was the truth. But I said, here's what we're going to do. We talked to the underwriter, said, let's just back that money out. We don't need the money. It's not like we need the money to close. So they just backed it out of the formula, and we just went on our way and closed. But it does show up sometimes. So be prepared if you have, let's say, an IRS deposit that came in from your tax refund. Okay. It's usually easy to document because you'll say IRS on it. But if it doesn't disclose where the deposit comes from, they're going to want to know where the deposit comes from. So that happens as well. Property tax shock. Now, this only had, and this came up with this guy in this the client I was just talking about, because the the property was sort of a country property. It was a double wide on 5 acres, and at the time the taxes were only $100 a month. Okay, the property was appraised for about 300, as I recall. 350, actually. It was around 350. And I said, look, I promise you the taxes are going to be higher than this. He'd gotten 2 estimates, and the loan officers had used the $100 a month as the estimate because that's what the actual taxes were. And there's 2 reasons the property taxes were that low. One was because the seller was in his 80s, and he had been had an over 65 exemption on there for 20 years. So the taxes hadn't gone up as property taxes as far as school taxes. Plus, it's a country property. So their taxes are relatively low there in the first place. But in addition to that, he was buying 5 acres, but the taxing entity was only on 2 acres, and that they weren't counting the other 3 acres in the formula. So the property was appraised for much lower than they were selling it for because they weren't counting the extra acreage. Now we had to resurvey the property, get the whole 5 acres done, and we had to reassess it, because for tax purposes went from $100 a month to about $350 a month. So that's what, in this case, of the property tax shock. Now, it wasn't my fault that we had to do that. That's just the way it is. But I told him, I said, look, these estimates you're getting are not correct. These are wrong. These are low. These are too low. He was very payment sensitive, but at the end of the day, he accepts the fact that, this property is worth 350. Appraisal even came in higher than that. So he's happy with the property, but his taxes went from about $100 a month per the last year's taxes to about 350 we had to collect in order to get the escrow prepared to pay the property taxes in the end of the year. Let's see, insurance surprises. This is another one, because we talked about hail damage earlier on a deal. Now, what's happened, and I've been the victim the victim of this in the last several years, my wife and I, because we have several homes, and our insurance keeps going up. During COVID, insurance companies, I think by law, couldn't raise premiums, or they couldn't raise them very much. But after that, we're seeing insurance premiums almost double in the last 3 or 4 years. from let's say $2,500 a year to $4,500 a year on some of my property, and which is shock. Now that shocks me. But what else that happens is insurance companies are becoming very much more particular about what they'll insure. So sometimes if a property's not in great shape, or the roof's not good, or there's some conditions there, then he may get the client may have a hard time getting insurance. That's why you want to shop that out immediately. And I know some very good insurance brokers, and also some mainline insurance agents with State Farm and Farmers, but also some brokers who can shop it out for you. So you want to make sure you get your insurance quotes up front, because when we meet with a client, we're going to estimate $300 a month as an example, but it may be 350 or maybe 250. So we want to make sure we tighten those numbers up as soon as possible. And the same with taxes. Now, one that comes up occasionally with first-time buyers. Matter of fact, I had a first-time buyer back out. This is kind of shocking. They backed out of the purchase because they were, let's say he was around 30, 31. And he wasn't, typically the young people are going to ask their parents about, and some they probably still do, sometimes the parents get involved in the transaction, and they may not like this or that, and the kids, of course, are going to listen to their parents, which makes sense. But this this young man was married, no kids yet, was going to buy their first home. And they went on Chat GPT and asked Chat GPT if it was a good time to buy properties in Austin, Texas, and Chat said no. So they backed out of the deal because some AI tool said it wasn't a good time to buy. So I thought that was kind of weird. I'm not sure that's really turbulence, but these are just things that come up, So it may be worth asking Chat. I don't know, but that was kind of funny. Another one that I could talk to a lot of people who are shopping for loans. As a matter of fact, I teach people how to shop for a mortgage. I wrote a white paper called The Truth in Lending, where if you read it, you'll have a lot of good questions to ask other lenders as you're shopping around. Now, here's where it comes into play, because lenders, most clients don't know how to read the estimates. They're called loan estimates. In the old days, we called them good faith estimates. Okay. We've changed the terminology around, but it's the same idea. Same idea as we get a profile of what you can qualify for. Then we list and itemize all the charges on the loan. And there's probably a good 10 to 13 different charges. There's lots of parties involved, from the lender to the appraiser, to the survey company, to the title company, attorneys, recording, et cetera, et cetera. And most people don't know how to read those things. So I line them all up and I say, here's how do you compare. Now at the end of the day, we've talked about this as well. When you shop for a mortgage, you want to shop for the APR on the loan, not necessarily the rate. The APR is to disclose to you the cost of the money in the first year, including the interest rate and any points you pay and any fees you paid. They go toward the prepaid finance charges, which calculate the APR. That's how you really want to shop for a mortgage. And so a lot of, and also make sure you're comparing apples to apples on the loan type. Like my client moving to Gerald, he qualifies for a USDA, and I showed him a conventional loan, I showed him an FHA loan, and I showed him a USDA loan. 3 different products, same property, same price, different rates, different fee structures, and different payments. And the USDA by far was his best option. Now, if he had been a veteran's even going to get you a better deal. So if he had been a veteran, I would have showed him a VA loan, which would have been his best deal for sure. I promise you that, because they had great credit. Couple more things. One of them that comes up occasionally too is child support obligations, or any sort of alimony that you may pay if you're divorced, or child support or alimony. Child support is probably more common, because people don't think about disclosing they've been divorced, or they don't disclose it because they only think about debt being credit cards, car payments, student loans. They don't think about child support as being a debt, because typically it's deducted from their pay stub like a 401k, so that it's out of sight, out of mind sort of thing. But once I had a case not too long ago where the guy was paying like $800 a month in child support and didn't tell me about it. And I don't think he was trying to get by anything, because it's clearly on his pay stubs, his child support to the attorney general. And so that kind of caused a hiccup, because at that point he had to pay off a car. He only owed $5,000 on his car. It was around $500 a month. So he had to pay off that car in order to get the debt to income ratios low enough, which he had the money. It was a problem, but he was going to owe child support for the next several years. And so we can't just discount it. It has to be documented. Um, and that kind of speaks to probably the last one. We're going to talk about folks who don't actually tell the truth. Now, I don't experience a lot of fraud in my business. There's just not that many people who are trying to scam us in my experience. Again, but they don't know what they don't know. So they don't tell us everything. Like I had a guy that was buying a home and he was from India, but he owned a home in India as well. And we knew he owned a home in India because it showed up on his tax returns. It was a rental property, actually. And so we had to document the information. And he didn't tell me that up front because he owned a couple properties in Austin, which we clearly documented, but he didn't think about the home in India. So, but really a very qualified guy. It wasn't a problem, but we had to document the information on that. Is there a mortgage on it? What kind of insurance do you pay, et cetera, et cetera. So lenders are going to be very, very thorough. So I just want to kind of go through a couple ideas of turbulence. It's about time to wrap it up. But if you need to talk to me about any situation that comes up in your housing needs, mortgage needs, if you will, call me at 512-789-6967 or Texas Mortgage Source is my company, whether it be a reverse mortgage or a purchase mortgage or a refinance or a cash out or a construction loan. We cover all those things. And so give me a call. Look forward to visiting with you. We'll see you next week. I've got a great guest on next week. He's a financial planner. We're going to talk about the benefits of the senior market, which is me. I'm included in that market. The benefits of reverse mortgages for seniors and how they can play into your overall financial picture and how you can leverage some of the equity in your property if you're over 62 to help you pay some of your living expenses. So until next time, thanks for coming.